I'm joined today by Philip Charls, Chief Executive of the European Public Real Estate Association. Morning, Philip.
Good morning.
So I'd like to start by talking about Brexit. Earlier on, you expressed the view that you thought everyone would be better off if the UK stayed within the European Union. That hasn't happened, obviously. So what do you see as the effects of Brexit on property markets?
Yeah, well, I think if you look at, the investors are crystal clear. If you look at the numbers, the UK went down year to date, total returns by 25%. Developed Europe ex-UK is down by 3%. Another way of looking at it, if you look at 5 years total returns, UK sits at 11 and continental Europe 13.5, so much closer together. So it's a clear signal from the markets. I think the good thing to look at is if you look at current dividend yields, they're about equal on either side of the Atlantic, 3.8%, so close to 4. And in the low interest rate environment that we have, you can argue that investors cannot ignore the UK market, regardless of the outcome of Brexit.
And obviously we've had a big election here in the US. Do you see any impact on that on European property markets?
Well, I think markets like everywhere else in the world, they reacted very negatively and in shock, so to say, after the conciliatory acceptance speech of the president-elect. I mean, they rallied back up again. We hear a lot now about possible tax cuts, about possible infrastructure investments. That could be a boost, obviously, for the US and therefore, obviously, also for Europe. My attitude would be to reserve judgment until we have a clearer picture of what the future plans are going to be like.
And what are the other big developments you'll be watching in the coming year?
Coming year is a big election year for Europe. We actually start at the end of this year in Italy with a referendum that might have an impact on the sitting Renzi government. Then we get elections in France, in the Netherlands, in Germany, all extremely important countries for the EU and for the European economy. And to be honest, I don't know. I mean, we might be in for another black swan event like we've seen in the UK and like we've seen in the US. It's very clear that there are a fair number of people who feel left behind after the global financial crisis. And they are relatively easily attracted to all sorts of populist parties. So there's very little we can do for next year as a European association. The two other areas where we are, I think, much more positive. That's number one, we are big in standard setting for our companies reporting and accounting. This year we've seen a fantastic step forward. About 2/3 of the index by market cap is at gold award level. Our team, managed by Hassan Habir, has done a fantastic job in getting us there. And the goal for next year is that 80% of the index will be at that level. The second part is the further development of REIT regimes. We are, as I always said, we're not the United States of Europe, so we don't have a European REIT regime. So we have 12 countries with good REIT regimes covering 83% of the European GDP. We miss 3 important ones, Portugal, Sweden and Poland. We work on that and I have good hopes that Poland will get there. And it would be a fantastic start of the new year if we got the Polish REIT regimes up by the end of this year or the beginning of next year. So I'm positive that it would be further growth of the market in Europe.
And for more news and analysis on all things REIT, be sure to visit REIT.com.